Everyone, and welcome to a lesson that I'm super excited about because I love taking confusing financial topics and making them very simple, not even just for people to understand, but to go out and act on if you're ever presented the opportunity to do so. And when it comes to your financial life and world, you're presented with a lot of opportunities to act on stocks and bonds. And what I find is that when people are confused on the topic itself, like they don't even know what a stock and bond is, at least to a 100% degree, right? Then they don't take action that they need to take on the topic because they don't understand it in the first place. And so what I'm going to do here today is just try to make stocks and bonds very simple for you. That's the lesson topic today, which is stocks and bonds made simple. And my objective is to help you understand what stocks and bonds are and how to utilize them in your wealth growing strategies. Let's just keep it simple. All right, let's just keep it simple. And so let's start off with what a stock is, right? A definition of a stock, very simply put, a stock represents ownership in a company. When you buy a stock, you're buying a piece of that business. So when I buy Nike stock, I now have ownership in Nike stock in the form of what they call shares, right? So simply put, Nike, it's not Nike stock. Simply put, stock is just ownership in a company, right? When you buy a stock, you're buying a piece of that company, right? Makes sense? I guess you can't really tell me if it makes sense because you're watching this on YouTube, but here we are. Just let's keep it moving if it does. If not, pause it, listen to that again, and then let's move on. All right. So how they work, right? So if the company grows and becomes more profitable, the value of your stock can increase. You can also earn dividends, which are payouts to shareholders. All right. So let me break this down here a little bit. If the company grows and becomes more profitable, the value of your stock can increase, right? And so let me break that down a little bit further. Let's say that you buy, I'm just going to stick on the Nike stock train here. You buy Nike stock for $10, right, per share, right? And so Nike starts doing much better, right? Their profits are growing, the company's growing, the value of the company grows as a result. So now the shares aren't going for $10 a piece, they're going for 20, right? And if you sold your share, you would make that $10 difference, right? And so that's how you make money off of stocks. For when the value of the company increases, the value of the stock that you own also increases. So that means you bought it for $10, now it's worth much more. If you sold it, you would make the difference, right? Just like if I bought a house right now for 100,000, in a couple of years it's worth 200,000. When I sell it, I get my 100K back plus that 100K profit. Kind of same scenario here with stocks. All right. And then you also might earn dividends, which are payouts to shareholders. And so dividends, as this mentions, are payouts to shareholders that can happen on a certain frequency, right? Most times it's quarterly and or annually, where the company decides to basically just pay you out some funds for saying thank you for being a shareholder, right? In the form of what is called dividends. And so it's the other way that you can make money off of owning stocks outside of the value increasing. And so some key traits here, right, when it comes to stocks, right? High potential for growth, right? But they're also risky because they can fluctuate a lot. Like there's some stock that you could buy right now that could go up by 30%, but it also could drop by 30%. And so just some key traits to keep in mind, especially as we roll into this comparison to bonds. All right, so real quick, stocks are just ownerships in companies. So if you buy stock in a company, you now have a piece of that company. All right. Now let's look at bonds. Right. They're two different things. And so what are bonds? Right. Bonds are like a loan you give to a company or government. In return, they agree to pay you interest over time and return your money, which is called the principal, when the bond matures, which just means when the loan, if it's a 10-year loan, by the end of that 10 years, the principal and the interest must be paid back. That's what it means by maturing, right? And so simply put, a bond is a loan to an entity. The riskier the entity, the higher the interest that you can make, right? And so, for example, if you were lending out a bond to a brand new tech startup company, right, that is very risky, you could make 30, 40, 50% off of that bond, right? But you also have a 30, 40, 50, 60% chance of not getting your money back, aka the risk, right? Let's go to the other end of the spectrum and talk about the safest entity to lend money to, which is the federal government, right? You are most likely almost guaranteed getting your money back, so there's very little risk, but you can only make, it just depends, but I'll just put out a rough ballpark, you probably only make around 4 to 5% on a good year on what are called treasury bonds, which are just simply government bonds, giving loans to the governments in the shape of a bond, right? And so the point being is bonds are loans to entities. The riskier the entity, the higher the return on investment that you can make. All right. And so how they work, you're essentially just acting as a lender instead of an owner, right? Lending money instead of buying ownership in the company. All right. And so key traits is they're steady, they're reliable income through interest payments, right? They're lower risk compared to stocks, but with less growth potential, right? So like it's almost guaranteed money. Well, let me not say that, right? The interest rate that's being paid back that is agreed upon by the entity. The federal government says, okay, we're going to give you 4%, right? Or this riskier entity is like, okay, we're going to give you 15%, right? That amount of money, if paid back, obviously the interest or the return on investment is guaranteed compared to the stock market where it's like, oh, this could do 10% this year, this could do 20% this year, or this business could, the stock value could drop by 10%. And so really it's steady and reliable income through interest payments, right? And so if they agree to an interest payment, that's what you're getting, right? And stocks in the market, like you don't know if that Nike stock's going to get 20% this year, 5%, negative 10%. So I hope that makes sense. All right. So let's wrap it up here. Key differences here. Ownership wise, like we mentioned, stocks are just sharing a company or ownership in a company. Bonds are loans to, screwing up my formatting. Bonds are loans to a company or government. The risk reward, stocks are higher risk, higher reward, right? Bonds are lower risk, steady returns, or lower risk, lower reward, right? Income potential, right? How you make money off of stocks is dividends plus the price growth, right? And then bonds, you're just making money off the fixed interest payments, all right? When to choose stocks, when to choose bonds, and then we're going to wrap up here, right? So stocks are best for long-term growth and if you can handle ups and downs. Because one year you might make 20% off your stocks, the next year it might drop by 20%. So it's quite volatile, right? It's great if you're focused on building wealth over decades. Like, yes, it'll be volatile, right? And it doesn't go up like this over decades, right? But it does go up. It just looks like this. Right? But progressively it's increasing. Even though it's going up, dropping a little bit, up, dropping a little bit. Over time, though, you do win, all right? And so bonds are better for stability, especially if you're nearing retirement or want to steady your income, right? What this is saying is if you're getting near retirement and you like the amount of money that's in your retirement account, you're like, okay, there's 2 million in there. I want to make sure that there's 2 million in there by the time I retire. We would transfer your investments from stocks, which are very volatile, over to bonds to increase the likelihood of there actually being 2 million in there when you go to retire. All right. And so it's a good hedge to balance out risk in your portfolio. All that means is when you buy into stocks, right, it allows for stable, consistent, guaranteed growth. So that can hedge against the risk that you're taking, right? Did I say stocks? When you buy bonds, right, you get that guaranteed stable growth, right? So you can hedge against the risk of your investment strategy in stocks, right, to make sure at least something in your portfolio is stable, guaranteed, and growing. All right. And so stocks and bonds are like teammates in your financial journey. Stocks build the offense, aiming for growth, while bonds play defense, adding stability and security. Right. So I hope this helps. To recap real quick, right? Today's lesson was stocks and bonds made simple. My objective was to help you understand what stocks and bonds are and how to utilize them in your wealth growing strategies. Again, let's keep it simple. If you learned something here today, make sure you like and subscribe and comment your biggest takeaways on this piece of content. And if you feel like someone would benefit from this, please share it with them. Keep coming back. I'm going to do my best. What are we at? 9 minutes now? Something like that. I'm going to do my best to keep these short and sweet, but also not rob you of the value that you need to be able to take control of your finances and achieve that freedom I know you'll want. See you on the next one.